Hello guys, hi, this is Ganesh Naik. Thank you very much for joining me for this video. I'm going to be talking about the book which is Market Risk Management and Measurement from FRM Level 2. I'm going to be walking you through the entire book and highlighting few important concepts which I feel can be tested in the upcoming exam, which is November 2022. If you like this video, please share and subscribe to my channel and share this video with your friends who are also appearing for the exam in the near future. So with this, let us start with the discussion for the market risk book. Okay, I'm directly going towards the first chapter, which is estimating the market risk measure. If you have read this book, this chapter, first chapter is more or less connected to the concepts of level one. Okay, I'm going to be marking out few important sections over here and there. Historical simulation, I'm making it slightly bigger. Historical simulation approach. This part you should definitely read because this n plus 1 is something new than your level 1. Okay, marking this question is also star for that. Parametric approach, this paragraph, star, this is nothing but delta normal approach. Don't get confused with the formula, this is similar to level 1 only. Next is log normal approach. This formula is important and mark this as this question is also star. As you move ahead, expected shortfall, current risk measure. This first paragraph is important. This standard error part is not heavily been tested as such. So I'm not highlighting, but this section, which is connected to the formula, the basic understanding, that is important. And QQ plot is double star. Very, very important. The entire section, all of this, the diagram, everything is important. You should be very clear what does QQ plot helps you. Okay. When you see such kind of a diagram, which tail it is referring to, whether the tail is heavy or thin, all of that should be clear. Okay. Let us go towards the second chapter, which is parametric approach, right? Non-parametric approach. Okay. So these two chapters are again connected to level one discussion, parametric and non-parametric. In the non-parametric, the bootstrapping historical simulation paragraph and this paragraph you should clear on. Surrogate density is basically connected to this diagram. You should be aware about what is happening in the diagram. Weighted average approach, uh, age weighted approach. The formula is not tested in terms of calculation, but understanding based. Again, the volatility based approach along with the formula. Understanding is important. Rest is okay, everything is okay as of important wise. Disadvantage of the non-parametric, you should read definitely marking it a star. Let us move forward towards the next point. So parametric approach, EV, extreme value theory. Okay, that has also been given in this section over here. Managing extreme values, read this paragraph. Don't get worried about these big notation. They are not tested in the exam as such. You should remember these part, very, very important, mark it a star. Read this section also, mark it a star. Peak over threshold, first paragraph you should be reading. Generalized Pareto, not so important. VAR and expected shortfall, this part. Formula is also not heavily tested in the exam as such. You can read this entire section, mark it a star. Multivariate EVT is okay. Let us move towards the next chapter. Backtesting, right? Backtesting is important, double star for this entire chapter. This chapter is connected to operation risk part also. A lot of the other section, the discussion is there for this chapter. That's the reason I'm highlighting it. First paragraph, what is backtesting should be clear. Then the concept of taking clean return when you're doing the backtesting, how should you do it? That aspect and this part you should be clear on. Failed rate. This calculation of failed rate is important. There will be a sum also. This is important, marking it as star. This model verification part, not so important. I'm not highlighting it. Type 1, type 2 error as a concept is important, especially this diagram where they're talking about the numbers 10.8%, marking it a star, and this 12.8%. These diagram are important. For the unconditional, if they ask you this approach, the conditional unconditional coverage, they will give you the table. Okay. But over here, this logic of 3.84 is important. And this section, the figure 4.3, this entire part is important. Calculation is not tested as such. Okay. The conditional coverage part, you're talking about the events or bad days happening together, clustering of things. So read the first paragraph and remember this formula. This part, Basel committee rules, double star, very, very important. This is the core of the chapter. Everything is important, especially this table. You don't need to remember the table as such, but you should remember that it is moving from 3 to 4. Okay. And these reasons, if supervisors find that there is a breach, what will how will they take care of it? That is also important. Yellow zone part, mark it as star. Understanding is very, very important. This entire basal part over here is very, very important. Don't skip it. As we move ahead towards the next section, the VAR mapping, again, an important chapter from the exam perspective. Okay. The principles of VAR mapping, marking all of the principles as star. Moving ahead, general risk, specific risk, very, very simple, straightforward. Formulas are not exactly tested as such. Yes, in this, the principle and the duration mapping approach is important. Cash flow approach, even though it is slightly calculation driven, in the exam, they don't expect you to do the calculation. You should look at this example. How they got the principal part is also important, and how they got the duration based part is also important. Calculation of duration is not important. They've just shown you as a reference point. Okay. This part, the final calculation, marking it as star. Cash flow mapping approach is okay. There's no reason, there's no need for you to read or can do the calculation of diversified VARA. Don't take pressure on that part. Stress testing, VAR, yes, benchmarking. Benchmarking as a concept is important. Okay, so read this. This is more or less a discussion. Okay, nothing such calculation based part is here. So, but you should read what are these numbers and all of that. You should be clear on this section. The formula for tracking error is not tested in the exam, so don't worry. This part is tested, mark it as double star. Mapping approach for linear derivative is okay. You can skip this entire part when you are revising. For the first time, definitely you should read. But when you are revising, I don't expect anything explicitly to be tested over here. We can directly go to the next chapter, which is your message for academic literature. This is small theoretical chapter. It's a combination of a lot of basically they're saying that what other authors or academians are talking about with respect to risk measure, and they've given you few pointers for each of them. So time varying volatility you should read. This part also you should read. Intraday liquidity, endogenous liquidity part, and this part you should read. Risk measure, expected shortfall you should read. For stress testing, these three pointers should be read. Unified approach, risk diversification you should read. Balance sheet approach, cyclical feedback loop. Read. Let us move towards the next chapter, which is correlation. Okay, there are a few chapters which are connected to correlation in the entire curriculum. This is one of them. Static and dynamic correlation. CDS is very basic. Read the wrong way risk concept. Basic correlation calculation not so important. A repeat of what you have already seen in level 1. Should read this part. Correlation in trading. This is not tested as such, but you can read. Conto option double star. important for the exam perspective. This sum is also important. You should be clear what is happening in quantum. Correlation swap also important. This entire part, marking it as star, marking the sum as star. Risk measurement is okay. See, this calculation, even if you don't use a variance covariance approach, you use a normal delta normal approach, you'll still get the same answer. So don't worry on that part. Relationship between var and correlation, marking this diagram as star. This part is connected to Basel backtesting var chapter. Next, more or less, is read this part and this part. Rest almost everything is okay till here. Default correlation you should read this diagram and this paragraph. Concentration risk is important, marking it as double star. Mark both of these questions are important. This formula you should definitely read, but historically they have not tested, but definitely you should read and look at the formula properly. Okay. So with this, we have completed the chapter. We are going to move towards the next chapter itself, which is going to be empirical properties of how actual correlation happens in a real world. Very small chapter, very few important points. Average correlation is okay. You can read this part. Sorry, the second part is important, not this one. This part is important. Mean reversion rate as a concept, you should be clear. And this sum is important. Autocorrelation as a concept, you should be clear. And mark this question as also star. Best fit part, if you could remember, just remember this table. Rest everything is not required. And I'm not talking about the numbers as such, I'm only talking about this, the best fit distribution. Okay. This best fit distribution has been tested in the exam. Let us move towards the next chapter, which is Capola, right? Financial correlation bottom-up approach. It is nothing but Capola chapter. Capola, how does Capola is used to find correlation? Gaussian's Capola is okay. Read this part. Percentile to percentile mapping is okay to be remembered. Okay. Now over here, they do not expect you to do any calculation. This is more understanding based question. Okay. Choxi's decomposition is okay. Best you can move away from this chapter. You should be doing that chapter late, very late, when everything else in the curriculum is done. Empirical approach, this chapter is connected to your DV01 calculation, which was there in level 1. Tips, regression hedge, is you should read this example and how the hedging has been done. You should be clear on that part. Hedge factor, this part, marking it as star. Two variable approach is okay. Level and change is okay. Principal component analysis, you should read these 3 pointers. Let us move towards the next section. Science of the term structure. This is where the term structure part happens. Very, very important chapter. Over here, we should be talking about backward induction as a concept. The sum, okay, and all of them you should be reading. You should be clear on the concept. These two paragraph are important, understanding wise. Why are we using risk neutral and not true probability? The binomial tree calculation, any sum in this chapter you should not skip ideally. Okay, we should be clear on the calculation. Recombining tree is okay. Constant maturity swap has been tested in the past exam. Please do not skip this. Okay, marking it as double star. Option adjusted spread is okay. This part is important. Callable bond, this diagram is important. This concept of negative convexity is important because we have been hearing about only positive convexity. That is why I've highlighted it. The rest, everything is okay. We can move to the next chapter, the second chapter of term structure. Flat yield curve is okay. Upward sloping yield curve is okay. Downward sloping is okay. You should read this section. Interest rate volatility. Over here, the main part is what is the core crux of this discussion, the entire calculation that they are trying to highlight. The convexity effect is very, very important. Mark this question as also star. This part, in fact, the first paragraph, this paragraph important. This paragraph, incorporating risk premium is important. We're going toward the third chapter of your models, which are models for your term structure part. First model without drift. Calculation is not so important. This part, addressing the possibility of negative rate, is important. The entire discussion. Effectiveness of model. For this, you'll have to look at the diagram from Guard book. Drift part is okay. Hooley model double star. Okay. This calculation or this tree is very, very important. They have been asking this question, the calculation part, how it is connected to model 2 is also being tested. Mark it as star. Arbitrage free model is okay. Read this paragraph. Isaac model, mark it as star. This formula very, very important. They will ask you to do the calculation. So be ready when this chapter comes in. You should be clear on the calculation part. The rest is okay. This part, mark it as star. Isaac model effectiveness is okay. We can go to the last chapter of the term structure, where volatility and distribution, we have time dependent volatility, time dependent drift path. I mean, more or less, time dependent volatility is discussed more in detail. So, model 3 is okay. CIR and this log normal, okay, they are important. This diagram is important, and this part is also important. Log normal drift, the calculation is important. That can get tested in the exam. Rest all is okay. This chapter is not heavily tested as such in the exam. I have not heard about it from the students. Most of the time they are testing it on the first or second or max third chapter from the Hooley and Weizsäck model perspective. They test. Volatility smile is very, very important. Okay. The concept which is over here, this part is important. Volatility smile, this foreign currency part is very, very important. How does this diagram comes into picture? They are talking about the implied volatility connection, very important. Equity part. Why do we see such kind of a diagram? Okay, again, you should read this chapter from Guard book. Very good conceptual based, they have given it. Okay, these two, crashophobia, leverage, very, very important. They have been tested in the exam. Volatility term structure is okay. What is volatility surface? You should be clear. Greek's part is also okay. Price jump, frown, that part. Why do we see that? Is also important. There's one more chapter which is FRTB, which was added later on. This chapter is actually connected to your Basel related chapter in ops risk. Okay, so I'm directly going towards the important section. This is worth reading it. This is worth reading. Should read this also. Liquidity horizon is okay. Don't take any tension of the liquidity horizon, not at all tested in the exam. I've not heard about it. This paragraph, profit and loss attribution is okay. This part, Jump to default important, mark it as star. So we are almost done with this book also. I hope this video will help you to do a quick revision of all the important chapters 1 or 2 weeks before the exam topic. If you like the video, do subscribe to my channel and also share this video to your friends who are appearing for the FRM Level 2 exam in the future. Thank you very much guys for joining and watching the video.